Global markets are holding their breath with three crucial central bank decisions in 1 week. This week marks a pivotal moment for the global economy. The Fed is poised to make its first interest rate cut since Donald Trump returned to the presidency. And it doesn't stop there. The Bank of England and Bank of Japan will follow with their own key announcements. By the end of the week, rates affecting 2/5 of the global economy will have been tweaked or reaffirmed. So what should we expect? Paul Hollingsworth is head of developed markets economics at BNP Paribas. So Paul, President Trump expects a big cut from the Fed. Do you think the US central bank will deliver a jumbo cut?
Our expectation is that the Fed will deliver a 25 basis point cut rather than a 50 basis point cut. And although we have seen some weakening in labour demand come through, and so the downside risks to the labour market have been building over recent months, we don't think there will be a consensus to move by a jumbo amount for a few reasons. The first is that the weakening in labour demand has been matched by a weakening in the supply of labour, in part due to tighter immigration policy. So that means there is not much slack building in the labour market, and we see that through the fact that the unemployment rate has remained broadly stable over the past year. And the second reason is that the Fed is closer now to a more neutral policy setting than it was when it did the jumbo cut 1 year ago. So there is less policy space for them to move by as much. And the final point to make is that Chair Powell, in his Jackson Hole remarks, he talked about the Fed moving carefully. And again, I think the word carefully suggests that there is probably a bias to move in smaller 25 basis point increments rather than moving in one large move.
Well, the Fed debate has turned to the pace of cuts as well. Will a cut this week set up a smooth path to lower rates?
So we think this will be the start of a shift in the Fed's reaction function that really prioritizes minimizing downside risks to the labor market over concerns about inflation. So effectively, the Fed thinks that inflation and tariff-driven inflation specifically will prove to be a one-off. And so it's believed to be transitory unless proven otherwise. And so within that framework, we think that relatively slow labor demand over the coming months will prompt the Fed to continue easing. So we're looking for 3 cuts this year, September, October, and December. And then we're expecting 2 more cuts next year to kind of take the total to 5 interest rate cuts of this cycle. I would just add here, though, that calling anything smooth in the current environment is somewhat tricky. The Fed is facing really non-linear risks to both sides of its mandate. On the one hand, the possibility of a much larger cyclical downturn in the labor market, and on the other hand, the possibility of much more entrenched inflation. So within that relatively smooth profile that we're envisaging, there are risks on both sides.
Well, division is growing among the Fed officials. Could we see the first meeting with 4 dissents since 1990?
That's not our central expectation. We think that some of those that have been calling for a 50 basis point move, they've sounded a little bit more balanced, and we would expect them to side with the majority in voting for a 25 basis point move. Similarly, some of the more hawkish members that are perhaps a little bit more concerned about tariff-driven inflation, again, we think that they will probably acquiesce and vote with the majority for a 25. But clearly, the talk about possibilities of dissent, that does show you that there is a real spectrum of views on the FOMC at the moment. And that does come back to this difference of opinions on the balance of risks, and in particular, the risk around tariff-driven inflation. Will it prove to be a one-off, or will it prove to be more persistent? And that is driving some of these differences of views at the moment.
Let's switch now to the Bank of England, and they are expected to scale back active gilt sales. What would this mean for markets?
So our expectation is that the BOE will end active sales altogether. So that would leave the future of balance sheet reduction to really come through the maturing gilts on the portfolio. I think there is a risk that they decide not to go that far and instead choose to lower the envelope from 100 billion now to something in the region of 60 to 65 billion. So that would effectively keep active sales at around the current pace. The bottom line, though, is that the Bank of England is going to take steps to try and reduce some of the pressure that we're seeing in the long end of the curve. So what does it mean for the markets? In our view, this is something that would help to flatten the curve effectively, because they are trying to take steps to mitigate some of those pressures.
So finally, Paul, the Bank of Japan closes out the week, and it's seen holding steady this month. But will they signal October as the date to resume rate hikes?
We don't think that the Bank of Japan will signal October. We think they're very much in wait-and-see mode at the moment and really trying to balance some of the domestic price pressures that are building with some of the global risks that we see, including the impact of higher tariffs and some of the downside risks in the US labor market. So against that backdrop, we think that they will keep relatively kind of neutral guidance, I guess. And our view here is that the BOJ will resume hiking in December, and we envisage them hiking hiking of up to 1.5% by the end of 2026, as they start to see more evidence of those downside risks disappearing, and on the other hand, those strength that we're seeing in domestic price pressures building over the course of next year.
That was Paul Hollingsworth from BNP Paribas. Don't forget, you can watch more videos on Reuters.com.